It's Forex Focus, brought to you by IG. Today was Fed Day, meaning the U.S. Central Bank met for the third time this year to set the overnight interest rate. And like many of the recent meetings, the focus was not on the interest rate decision itself, which was another hold at 5.25% to 5.5%, but the focus was on Fed Chair Powell's comments following the meeting, the questions he answered from reporters that give us a look and a feel for the Fed's outlook, the projections for what decisions are to come in the following months and years. We saw U.S. dollar fall. As Powell said, the likely next move is a rate cut, not a rate hike. We just don't know when. He gave us a lot of sound bites, a lot of things for markets to digest, and they did, including a stock rally that eventually sold off by the end of the day, but the U.S. dollar move ended up sticking in there through the rest of the trading day. What did he say? He said inflation is still too high to start cutting right now, and cited the core PCE inflation, the Fed's favorite, that just came in recently for March, staying at that 2.8%. Confident that inflation is lowering, but also time and time again saying the Fed will not rest until we are at that 2% level. Might not feel like a big jump, already being in that 2% handle at 2.8%, but to Powell and to Fed officials, 2% is very different from 2.8. So the Fed said they're ready. When inflation cooperates, they're ready to make those adjustments. But right now, in Q1 of 2024, is just too early to begin cutting. But he also said, was kind of backed into a corner by a reporter here, and was forced to say that the current rate, the target rate for the Fed funds interest rate at 5.25% to 5.5%, is sufficiently restrictive over time to get to their goals for both inflation and employment. He was very vague in how long this would take, no guess, but was confident that given enough time, we've seen the effects start to play out in the labor market, as we had job openings reported this morning as well, softer than expected. So he pointed directly to that, saying that demand is beginning to slow in the employment sector. Inflation has come down already from its highs to under 3%. So likely no more rate hikes, just a matter of when a rate cut will begin. And there's a lot of uncertainty, a lot of division amongst traders when that first date will be. A reporter tried to get Powell to answer the question of, will it be this year? Of course, he said, we're very data dependent here at the Fed. Once the data talks, we will listen. But CME futures markets back and forth over the past couple days. Yesterday, some strong employment data coming in around a minor data point, employment cost index, which is the growth of the overall cost to employ a civilian worker. So yesterday we saw odds looking favoring the September meeting for the first date of a rate cut, but now looking back towards that November meeting, no meeting in between those months in October. So it's these two dates we're looking for if it's going to be in 2024. Of course, there's December as well, where the likelihoods are still all over the map, pricing in anywhere from 0 to 325 basis point cuts this year. But now we're pretty 50-50 on September, if we'll get a 25 basis point cut there. But by November, traders predicting that we will, over 50% likelihood, we will have rates lower than at present. But he also said Fed Chair Powell, that is, that now we're looking at employment. Even though we know inflation is not there yet, we feel like we've gotten over the hump in a lot of ways, quelling inflation. It's just a matter of time there. But now, as per their dual mandate, containing inflation and promoting employment to a sustainable level, employment is now the focus, and it's timely with non-farm payrolls release coming this Friday, with the unemployment rate, with minor job statistics like the job openings this morning coming in all week. Eyes are all focused on this Friday non-farm payroll number, because they've done a good job with inflation. But if you're looking at this non-farm payrolls graph, you're seeing towards the end of 2023, thought we were at kind of more normal historic levels, and in 2024 just been ripping through jobs added month by month, and these numbers were even higher. They've all been revised down in the month following. So in either January or February, one of those numbers was 353,000 jobs added in that month. The next month revised lower. So it's tough to get a completely clear picture on this from this non-farm payrolls figure. But you can definitely see that there's still robust strength in the labor market in the U.S. And so now the Fed sharpening their gaze on making sure that employment is at a sustainable level in tandem with inflation. And how'd that play out in the U.S. dollar? The U.S. dollar sank against a bunch of major currencies. Euro dollar, which you're looking at here, breaking above 107. Some interesting price action back and forth. This is the hourly chart, so a big initial move up against the dollar. Some starting to come back, but the euro gaining in the hours following, right there above 107. British pound against the U.S. dollar rose above $1.25. And so a bunch of these major forex pairs, U.S. dollar pairs, that is moving against the U.S. dollar. A lot of strength. As you're looking here, we can see some hours from yesterday. Dollar gained a lot on that minor employment cost index figure that came out yesterday. I mentioned earlier that was stronger than expected, but now all the attention turning towards the end of the week, towards rate cuts at the end of the year. We'll see how this plays out for U.S. dollar, for stocks, for bonds across all major U.S. markets as we continue to digest what the Fed says and what to expect from the Fed in the coming months. Thanks for watching.